folks, we're going to move on into the area of securities regulation as promised. Again, this is an independent agency established by Congress. And the backdrop on this is, again, history. The Great Depression happens in October of 1929. The stock market precipitously crashes. Legislatures blame the stock market crash on the collapse of the economy, despite the fact that a lot of times there are a large number of issues. The stock market is a symptom, not the cause. And that's my personal opinion. The Great Depression is that the stock market crash was a symptom and not the cause of the horrible depression. It just was an example of things that were not properly regulated, things were out of control, and many other things were wrong with the economy at the same time. One of the things that's not mentioned often is that there was a drought in certain parts of the country. The Midwest was droughted at the time, so the breadbasket of America, being the great Midwest, was indeed struggling. Some of you, and I think I mentioned this early in the course, in high school read The Grapes of Wrath. Grapes of Wrath is a very, very compelling depiction of the drought, of this. The reason the Baobab family packs up everything they own and goes to California, the land of milk and honey, is because their property was droughted. They had no crops. They had no way to live. So, and that's what we're talking about. So there are a lot of other factors influencing things. We had a period of sustained growth during the 1920s, of course, called the Roaring Twenties. Some of you are familiar with that. We had flappers and the Charleston dance and all that kind of jazz. But other than that, we didn't regulate business very well. And so some might argue we have over-regulated business as a retaliation all the way back to October of 1929. In any event, Congress rushes into action, and 4 years later, only 4 years later, they come up with a law that governs the issuance of securities. Most of us just use the acronym today in this room, IPO, initial public offerings. How do we get securities out into the public? And we'll also talk about some exemptions for registration for small law firms, Reg Ds, and so forth. Then the other area is the regulation of trading activity, and that's the 1934 Act. So 33, getting the security. 34, a year later, how do you trade the security after it's been created? So kind of keep that in mind. You can tell 33 from 34. And of course, again, the creation of the Securities and Exchange Commission, which has done such a fantastic job that we had Madoff at Stanford. So, it's like, what did you fix? And then, of course, we had the big stock market crash in 2008, 2009. So, I'm trying to figure out what we're getting for our money here, folks, but it's an interesting area. So, I want to be familiar with the term here. You may hear again, blue sky laws. Blue sky relate to state laws, state regulation of securities. Not every state has securities regulation. Most states do. Kansas, first state to have state regulations on securities. And anybody know why the term blue sky came about? Something happened. Well, that's a very specific answer. Something happened.
I've always heard the term blue sky used to refer to goodwill for a business.
No, it's really broader than that. Blue sky is this is the intent, that everything from the ground to the blue sky is going to be regulated. Because the intent, but that's where blue sky comes from. The intent is that everything's a security. We're going to see that on another slide in a second here. And people will come out and, the Ponzi scheme. Ponzi was an Italian immigrant, comes to the United States, figures out a way to make a lot of money. He takes money from the early investors and he gives it to, he plays with the money so the new investor money gives unreasonable returns to the early investors, and then the early investors say, oh man, that guy Ponzi, he's a great investor. And that's where the term Ponzi scheme comes from, all the way up to Madoff. Madoff was a Ponzi scheme. no two ways about it. He took money from people. He spent lots of money on himself, owned a penthouse, owned a mansion in Florida, lived high on the hog, belonged to a bunch of country clubs and stuff where he would solicit customers. And it was very interesting. But again, the SEC, these rules did not prevent it. In fact, he was board chairman for a while of one of the Securities Commissions. It's like, yeah, he really figured this one out. Yeah, it's like, be an insider. So, and because of the patina of credibility as an insider, so to speak, people didn't question the returns. And again, a very sad situation, terrible losses. So he's in jail for only 150 years. Well, I think it's unfortunate. I think the reason he rolled over almost immediately, but the package deal was his wife ends up still a millionaire. I'd put her in jail cell with him. And the two sons were in the business. I would put them all in the same jail.
All of them were involved, but they got out clean.
Because he rolled over and said, yeah, take me and all that. I would have locked them all. I would have said, I got you. I'll take the others too.
Maybe too bad for everything. One of the sons turned around and committed suicide.
That I do not recall.
Yeah, I read that.
Yeah. But it's a very sad situation. The one charity completely collapsed as a result of the Madoff situation. Of course, you also get into issues like how smart were you to give all of your money to one investor, even if he's a pretty hot dog. You know, there's diversification we talk about in terms of stocks.
Greedy, and they want to double up their savings. I mean, greed is what generally makes people do illogical things.
As Gordon Gekko says, greed is good, right? So.
I think one of his schemes of how he did it was that he wouldn't accept part of your money. He had to get the whole investment.
Yeah, you had to have a minimum investment. I think the way he did his minimum investment was $500,000, and his marketing ploy was one of the most interesting in history. Is that he would never accept anybody who solicited them on the first time through. So went to all these country clubs and hung out with all these folks, and ran the life of a wealthy guy. And people would say, "Oh, well, boy, he's a really cool guy, and we heard these people over here, we're all happy with him, and I want to hang out with him." And you go up to him at the golf club and stuff, and he'd say, "Oh, no, there's plenty of people you invest money with, and I've got plenty of business. Go see somebody else." So that would increase people's interest in pushing money at him. And I think he did have a minimum $5 million, or it was a big minimum, because a lot of your private investment managers have a minimum here in Houston of $500,000. So $500,000 is pennies. So I think his was like millions. You had to have a certain number. And again, if you were a small charity, that may have been all of your investment assets. So, but pretty sad. But again, most of that is in the 34 Act. The 34 Act also deals with something we hear a lot about, is insider trading. So you think about that's because it's already been issued as a security, 34 Act versus 33. I'm just trying to give you some ways of thinking through this to kind of keep one act versus the other, okay?
So is it regulation good or bad? I'm still
Well, good regulation is good, bad regulation is bad. How's that for a specific, a very detailed answer? The problem that we have in the United States is we have an enormous amount of regulation. And you hear from time to time common sense people saying, you know what, we don't need more stinking regulation. We need people to enforce the regulations that were passed last year and 10 years ago and 20 years ago. Plus, people need to have some common sense. The whole Madoff deal, as was just pointed out, is driven by greed. Not complicated, driven by greed. And so people need to have some common sense about what they do. And I get called as a somewhat high-profile person. I get people calling and telling me about all these great investment schemes. All you need is $100,000 minimum buy-in, and I'm so protected. Like, well, what's the $5 buy-in? Generally, it's not a $5 buy-in.
Frugal is the word.
maybe 10 on a good day. But they would call me up and they tell me these crazy stories. Well, maybe we'll sell you a partial interest in a share. We'll let you put in 10 or 20,000. And so I would go from the person who told me about the deal to the next person, to the person that's actually supposed to be responsible for the deal. And I would say, tell me how this deal works. How do you get 100% return on your money in 1 month? And
that's common sense, right there.
Right. Well, that's why I always ask, because I'm like, I'd like to hear this story. And so I have yet to hear a story that I could repeat to you, because none of them made any sense to me. They're always overseas. It's a foreign investment platform, and this investment platform, they have to divest their profits. They're not allowed to keep their profits, so they have to turn them into this. They have to do that. And it's always these really complex stories, and it sure sounds a lot like a Ponzi scheme. Well, the first person in made 100% on their money in 1 month, so you should come in and put your money in, because then you'll make 100% next month. And I'm thinking, I think I wanted to be the test case in the first market. After that, I'm thinking this is too close to the Madoff end of the business. Yeah. But the point is there's all sorts of stories out there. Now, what's regulated? Here's a great slide for you. Just think about this. Look at all the stuff that this could be a security. An investment of money in a common enterprise from which the investor expects to earn a profit from the efforts of others. Basically, buying a stock in General Motors. That's a security. But an awful lot of stuff is a security. Sale of a limited partnership has been found to be a security. Now, there are 2 documents required to issue a security. A registration statement. Some of you know that as a tombstone ad, like in the Wall Street Journal. That's a registration statement. And a prospectus. The trouble with the prospectus is as follows. They create a legal liability for the business. So the prospectuses are so legally constrained that they almost all read the same way. We have this business. We're going to do X and Y. The risk behind this business is the following. Expect to lose all of your money. Kind of like, Dante's Inferno, all ye who enter here, give up all hope. It's like, well, if every prospectus says the same thing, they're useless. Now, if it said, hey, we're going to go sell environmental remediation in China, which one of the companies I have penny stock, lots of penny stock, and the company's deal is they take waste and they develop some type of sophisticated incineration process that doesn't generate air pollution, but allows them to combust the product in such a way that it generates electricity. And if you're a big city in China, you generate a lot of waste. If you come up with a way of burning the waste safely to generate energy, it can be a very cool deal. So, for all that logic, the stock is worth 30% of what I paid for it. That's why I never give anybody investment advice, But I mean, again, the prospectus, what does that mean?
Well, if it was a good buy at $1, you must really want to buy more at 70 cents, right?
They tried that with me. I said, I don't think so.
But they're making 30 cents for $1.
Now, where we want to focus when we talk about small business startups is how do we avoid doing an initial public offering? Estimated cost of an initial public offering a few years ago was $500,000. So if you're out there raising money by going into the stock market in a big public offering, you need to raise millions and millions of dollars just to get, because the first package of money is going to go to the people put it together. That doesn't put any money in your pocket. And it's probably $750,000 today, because I heard $500,000 a while back. So part of the game today is how do you go public without having to go through this expensive registration process. We call those exempt security offerings. First thing we're looking at is purely intrastate transactions. Don't get to run around the country and round up investors. So we're fortunate here in a big state like Texas. There's plenty of people who've made some money here in the state. You can finance a business here in Texas with some ease without having to go past the state line because it's simply a huge state. Same for California, same for Florida, you know, some of the large states, New York State, and so forth. So again, keep in mind you have to be careful because you may have state laws that work differently than the federal laws. Again, we're talking federal law only in this classroom. So because we can't talk about every state, it's too much material. And, you know, we know many of you are going to operate in multiple states or be in different states than you are here today. So we can't anticipate every state will be in it. But the point is that you need to look at intrastate offerings, pretty common, we call those private placements. Reg D is pretty well known. This is under the 33 Act. Total number of investors, 35. If you find you have an unaccredited investor, accredited investor, the definition varies, but basically one definition that I've heard pretty consistently is $500,000 in net worth without the equity in your private home. So that pretty, you know,
yeah,
our banker in the room saying, yeah, pretty much the rule. And so also people that have a level of sophistication. I don't play in that ballpark, I don't have the money, but I know some of my professor friends over at Rice do a lot of these deals. They may not have 500,000, but they're, you know, they're at the business school at Rice, they make very good incomes, and they're considered sophisticated investors.
You can, I'm sure the Homestead, Texas is difficult because of our Homestead Act, but
yes.
You can have $1 million in equity instead of $500,000
yeah.
and include your home.
Yeah.
So that's there.
By including the home.
By including the home, yeah.
Yeah. If you bought a cheap house in Bel Air and it's now worth $1.5 million.
Yeah, basically.
Yeah, because most of the people that have $1 million house have an $800,000 mortgage to go with it, or a $700,000 mortgage. So yeah, so they usually don't have $1 million in home equity. But that's pretty interesting. But the point being is to deal with the sophisticated investors who, if they get clipped because it's not going through the full review process, they can afford the loss. That's the theory behind this. It's kind of a brutal theory if you think about it. You know, it's like,
and they understood the loss potential.
Exactly. And I bought my, you know, $800 worth of penny stock, and I knew that it might not be worth anything. The good news for me is I don't need the $40 that's left, so I can leave it there, and maybe it'll go back up to something. You know, go back up to $200 or $300 or something. This is a small offering exemption. This is under Reg D, and this is real small amounts in the greater scheme of things today, $1 million and $5 million. Okay, so that's what we're talking about, is putting this together. Now, these slides were done before crowdsourcing became such a big deal. If you have something nifty keen to talk about, then one of the things you can do today is do crowdsourcing. And it's interesting, some of these crowdsourcings, I'm trying to think of one I heard about a few months ago, popped $2.5 million. You're limited to $1 million on crowdsourcing. I don't know what they do with the extra money, put it in a different venture or whatever, but yeah, I heard that one of these, it might have been somebody producing one of these games that you hear about. I hate games. I have a life, I don't play games. But it's interesting because I think it was a company that was marketing some game, and they did crowdsourcing, and you know, all the nerds who that kind of stuff all wanted in, and bid the stuff up, you know, $5 and $10. That, I mean, you know, there's a lot of people get involved in that stuff. Okay, I think it's very cool from a strange perspective. Certainly, you can package different offerings, small offerings. That's called integration. I don't see a lot of this, but sometimes you've got people out there who are peddling these. The second bullet is kind of relevant, which is restricted. Generally speaking, if you're in on some of these small offerings, you are going to be restricted at least a year. Many of them are restricted longer, like 2 years. One of the penny stocks that I bought is a friend of mine was one of the early purchasers of the stock, and they got a pretty good deal. I don't know if it's worth much today, but they got, since mine's way down, I don't know what theirs is, I don't know what her base is, but they have a deal where it's in at about, she was under a 2-year restriction, and it's often the stock is so low it doesn't do her any good. So nobody will buy it from her, so she might as well hang on to it. Again, the company has some good prospects, but it's interesting because you hear all this good stuff on several of the penny stocks I own, and obviously logic has nothing to do with the value of the stock. Because it's like, gee, this sounds like something people would want to put money into. Why isn't the stock doing better? So anyway, that's why I don't do stock advice. But and I'm not concerned at all that somebody sold me a bill of goods on the stock. But sometimes people invest a lot of money, and money evaporates, and people are mad. And this is where this is anticipated. Do you take legal action at this point? Folks, we've been at it for